Hello everyone, and welcome to today's 2 Degrees webinar, where we'll be taking a look at energy performance contracting and what the UK commercial sector can learn from what's already being achieved in the public sector. My name is Stephen Kennett, and I will be hosting today's session, and I'm delighted to welcome our presenters. Joining us from Imtech is Group Development Director Paul Burnett, who has a wealth of experience in the field of energy performance contracting. And from Commercial Property Development and Investment Company Land Securities, we're joined by Energy Bureau Manager Ben Brown. Today's presentations will last for around 30 minutes, which will leave us with 10 to 15 minutes for questions at the end. Before we begin, I'd just like to remind everyone that you can submit questions throughout the webinar using the Q&A box on the right-hand side of the screen. Just type in your question and press send, and we'll wait till the end before answering as many as we can. As an aside, if you should have any technical issues during the webinar, please use the chat box on the right-hand side to send me a message, and I'll get back to you as soon as I can. So without any further delay, I'd like to hand over to Paul, who'll get us started with today's webinar. So Paul, over to you.
Thanks very much, Stephen, and welcome to the virtual audience. As Stephen said, my name is Paul Burnett. I'm a Group Director at Imtech, and Imtech being a very large engineering services business in the UK. And I set up and I run the energy division within Imtech, which we call Low Carbon Solutions. We are one of the largest energy performance contractors across the UK. A majority of our work is within the public sector, which is the relevant piece here today. Now, obviously we go through intros, and my kind of piece and intro into this is to look at what is an energy performance contract, how does that work in the public sector, how do we implement these in practice, and why we believe they are a success in the public sector. And then at that point I will hand over to Ben from Land Securities, who will run through how they're much more prevalent in the public sector and why that is and what the private sector can do. And then we'll open the floor up for questions. Okay, so what is an energy performance contract? Well, essentially it is a partnership between the customer and the ESCO, the ESCO being the energy services company that will be delivering the energy performance contract. This is over a contracted term, which is generally the payback period, but it can be over whatever term is agreed between the customer and the ESCO. And the partnership being a very key word. I mean, the whole point of these projects and these contracts are to drive energy efficiency and to improve the performance of the buildings. They're not to make them aesthetically prettier. They're not to create new environments. All of those things can be done as part of it. But essentially, the whole point of it is to drive energy savings. Key point is that the savings, the results from the contract are guaranteed by the ESCO. And that underlines the fact that the ESCOs can provide the covenant to do that. They're confident in their abilities to produce the savings, and if those savings aren't being met, then there's a payback to cover that cost. Generally, when you're doing a true energy performance contract, those savings will always be greater than the payments to the ESCO. This can change depending on if someone wanted to do it over a shorter time scale, or there are elements being included in the energy performance contract that aren't purely energy related, such as capital replacement works. These savings are measured using the IPMVP method, which is the International Performance Measurement and Verification Protocol. That gives a standard methodology, so it is a methodology that is the common practice for energy performance contractors. And at the end of the contract, then 100% of those savings are solely accrued to the customer. Okay, so this is an example of an energy performance contract within a local authority. And the way this works generally, because the local authority can have quite a lot of buildings, they'll offer up a sample of their portfolio. In this particular case, the sample was 8 buildings, 2 corporate buildings, 3 libraries, a museum, and 2 residential care homes. We would assess those buildings and look to come up with an initial stage as a desktop audit and outline saving. From that, we get an award, and we'll then go through an investment grade proposal. That gets signed off, and then we implement the measures. And in this case, the guaranteed savings are at 31.9% across, and that's a portfolio saving across the 8 buildings. So some will be higher, some will be lower, but across the 8 buildings, it's 31.9 saving. That's 948 tonnes of carbon, which in terms of the total carbon of those 8 buildings, that's a 31.5% saving. That provides a financial saving of £197,000 a year, with the capital cost being just shy of £800,000 to deliver all of that work, and that gives a payback of around 4 years. Now, what we try to do on these, and the way energy performance contracts generally would work, is that you do quite a broad range of measures. I mean, they're the measures that were implemented. Underneath that, you'd have 2 or 3 times that amount of measures that you would assess, and then you're looking for trying to get the best bang for your buck in terms of a saving. Now, whether that's the client specifically wants to drive a carbon saving or a pound note saving would dictate which measures you go for, and we would just look purely for measures that are going to fall in that category and save energy or carbon. Now, as an illustrative purpose, you can see there before the ESCO works start, there's an energy cost. Obviously, that can fluctuate depending on tariffs at the time, but at that point in time, we're given as a benchmark. That was the annual cost of the energy consumption. Now, when we delivered this work, you can see there in red, that's the cost of the payback to the ESCO, and there's a saving still being given to the customer. So from day one, they are achieving savings, and then when the works are finished and the project's finished its measurement and verification on the payback period, and those works are handed back to the client, all of the savings then accrue to the customer. And here, as an example of an energy performance contract within a pretty large NHS trust. Now, the guaranteed savings here are pretty significant. It's a 55% energy saving across that estate, which is £697,000, with a pretty significant carbon saving as well. Now, those total cost savings to the client gave them a £1 million a year saving. Then obviously there's the capex payment back to the ESCO, and there's also an OPEX saving in terms of OPEX cost, in terms of operation and maintenance of the new equipment, the new assets. That was a payback of around 7 years, but the actual contract term on that particular ESCO is 25 years. It's been self-funded by the NHS Trust themselves, and it's a very big kind of lighting upgrade. I mean, the core of that particular project was a CHP, and they already had a CHP on site. It wasn't working effectively, so it was a huge optimization, enabling the CHP to be controlled much better, and new lighting upgrade. It's a pretty significant saving for an NHS trust that's been guaranteed over 25 years, all of which has been self-funded by the trust. And again, in terms of an illustration on a graph, it kind of lays out pretty clearly how that pans out for the NHS trust. Okay, so why, and there's just 2 examples, and we're doing a lot of that across the UK within local authorities, universities, hospitals, right across the broad range of the public sector. We're doing a lot of contracts. Now, the question, you look at it and you think, why is that a success in the public sector? Well, across the public sector, there are a number of OJU compliant frameworks for energy-related works. The ones I put on here are probably, are the most significant in terms of the Carbon and Energy Fund, REFIT, and Essentia. And the beauty of those frameworks, they're OJU compliant, so they have to comply to be very compliant. From our perspective, it gives us access to a pipeline of projects. So a lot of the donkey work in terms of generating a pipeline for people to bid for has been done, and the projects that come on there are all real. They've all signed memorandums of understanding. They have already been teased through. They understand how these things work. They know what they're looking for. So they come into the table with a good mindset in terms of what they're trying to achieve. In return, they also get access to the companies that can deliver these type of projects rather than having to go hunting around the market. We've all gone through the OJU compliance to get onto the framework. It's a lot of companies that know what they're doing and know how to do this stuff. It also gives good access to finance if these projects need to be financed by a third party or by the ESCO themselves. It's access for that type of route. Again, people don't have to go looking around. It does enable the customers in here in the public sector to look at holistic solutions because they're not being driven by an internal hurdle of 2 or 3 years. There's much a longer-term nature around it, and it provides a lot of a robustness around the procurement in terms of types of contracts, the process, the method of procurement. It's all very standard, or has been standardised over the last few years, so people know what they're getting into. They know the process. They know how it works. And it does give a route for people in the public sector to progress their carbon targets, and quite significantly in some cases. And it just provides a massive level of consistency right from day one to the completion of the contract and the completion of the project in its entirety. There's a lot of standardisation and consistency, which you generally don't get in the private sector. Okay, at this point, I will hand over to Ben. Thank you.
Thanks, Paul. Let's see if I can get these slides working. A little bit of background to me. As Stephen mentioned earlier, I'm now the Energy Bureau Manager at Land Securities. We're a very large real estate firm in the UK, own many iconic buildings across the UK, including the walkie-talkie, whether you love it or hate it, the Piccadilly lights, and buildings all the way really from the south of from south of England all the way up to Aberdeen in Scotland. So a large organisation with a very varied portfolio of buildings. However, why am I talking about public versus private? Because I was previously an energy manager for Haringey Council. I ran a shared service for Haringey and Hackney councils, and in fact with Imtech I went through an energy performance contract just prior to my leaving for Land Securities. So I'd like to think that I've got a pretty good understanding of the drivers for both the public and the private sector, although admittedly, and I'll hold my hands up on this one, I'm going to be relatively limited to the local authority view from the public sector, and indeed the real estate view from the private, although I have tried to think, well, what if I was a tenant or a large manufacturer? So hopefully I'll cover all the different facets of this. So I obviously had to have a bit of a think about why energy performance contracts are more prevalent in the public sector than the private sector. Now, I think, Paul's spoken a little bit about carbon, but what you'll typically see through my slides is that I don't really talk about carbon. I talk about a lot of financial levers, and I think that's predicated on the fact that certainly in the public sector, austerity over the last sort of 5 years has played a massive part in the way that the public sector conducts its business. I've also seen that there are some more sizable reductions, especially to the Department of Communities and Local Government in the latest spending review. So again, further challenges on how to reduce costs in the public sector, and on that, as you can see, I've sort of broken down the context as to why you might undertake an energy performance certificate in the public and the private sector by sort of 4 key areas. In terms of legislation, at the moment, granted that there's change on the horizon probably to CRC and to FITS, but and as I suppose as a byproduct probably to CCL as well. But I would certainly say that the legislation that's out there is ensuring that energy costs are really, whilst being extremely volatile, only in the long term going up. We've been relatively fortunate recently with a plateauing of energy costs over the last sort of 6 months or so, but long-term forecasts will always say they're going up, and of course a lot of that is driven by the energy market reform, which is pushing up the pass-through costs quite substantially over the next few years. So I think there's a real financial driver for both sides to do it. But then if I sort of break that down into, well, what are the other reasons as to why you might undertake an energy performance contract? Certainly from a local authority or a public sector perspective, there's from a brand view, there's always a mandate to spend taxpayers' money sustainably. I think that was nicely coined by Jonathan Porritt a few years ago when looking at sustainable procurement, and it's absolutely right. Under the Local Authority Act, that is indeed one of the primary elements of the legislation that drives local authorities. Where it comes to the private sector, the energy side of things, you take away the cost of energy, and really it's about maximising your brand value through CR. Now, the fact of the matter is there's choice there. You don't have to necessarily pursue an energy based strategy in order to enhance your corporate value. So from my perspective, you'll be looking at various other different programs in the public sector. I think currently everything goes when it comes to reducing costs, and certainly the carbon element that comes out of that is a bonus. And that brings me on to the finances quite neatly. In the public sector, there's never been more of a push to reduce costs, and with interest rates as low as they are, the Prudential Works Loan Board has extremely low and attractive interest rates, and it provides a very good opportunity and a really good financial context in which to push through some of these contracts. I mean, just on the austerity side of things as well, we're forcing consolidation really across the public sector due to job cuts. We're no longer in that wonderful position whereby we can go out to market for little bits and pieces, looking for maybe the best value or sort of local suppliers all the time, which would be wonderful. But unfortunately, with costs as they are, consolidating through simpler and cheaper procurement processes, as Paul's already mentioned, there's a lot of frameworks that are already established out there. But consolidating through that reduces your resource costs, but also drives economies of scale in terms of the installations, the energy conservation measures that you're going to get. And finally, in terms of risk, I think it's also worth saying that the private sector internal rate of return, typically they'd be looking at a much higher rate. Now, given the fact that the public sector can afford lower IRR returns, means that ultimately there's more opportunity to deliver some of the, I think, rather than looking at the low-hanging fruit, some of the longer-term investment opportunities which might prohibit the private sector from for contracting under an energy performance contract. So that's just a few of my thoughts on that one. I think secondly, what I'd look at is what sort of assets do you have? Well, in the public sector, I suppose, whether you call it a blessing or a curse, they own most of the property that they operate within, or they do have long-term leases, and that gives them a lot more flexibility in terms of understanding whether that ROI is actually going to pay back under the assets that they have. Now, certainly, asset management strategies recently in the public sector has been to sell as much as possible to release revenues and to reduce overheads. But what we're seeing is a long-term retention of core assets and consolidation of services under some of those assets, specifically things like libraries, where there's a lot more self-service. You've got longer opening hours in those libraries, and as a result, the core assets of local authorities are pretty stable. And of course, it will be the same for central government as well. Lots of long-term core assets, which therefore have the stability attached to them, which would enable energy performance certificates with returns of investment of over sort of 5 to 7 years to be realised. As a result, obviously, of owning and operating out of your own assets, you control your consumption, and that's very helpful. I've sort of mentioned here that certainly from our perspective as a real estate investment firm, we don't control all of our consumption. Tenants control a lot of our consumption in the offices that we run, in the retail units that we have as well. So it's sometimes very difficult for us to make sure that we're able to implement the most cost-effective energy reduction strategies, where we know actually half of that energy isn't going to be under our control, and vice versa. Tenants obviously will not have control over common areas, and so if you're a retailer or that's in a large shopping centre, for example, you're gonna still have that problem of having a lot of extra costs, which you don't have necessarily control over. Again, indeed, in terms of the asset management strategy from the private sector, you're not necessarily going to retain assets over the long time, unless perhaps you're a large manufacturer. Ultimately, what you're going to be looking at is the maybe potentially long-term leases, but if you don't have the opportunity for an extremely attractive package, short-term leases may mean that you won't necessarily look to invest long-term in energy conservation measures. And finally, I think the last thing I just pick up on that is that certainly there could well be some tensions around development and ops, and indeed capex and opex. I think in the public sector, most of these costs are actually all joined up in a single place, and you're able to really work to ensure that the capital expenditure is compared against the operational savings that you're getting. But if you've got two different teams operating two different budgets, sometimes that can create problems around what you can and cannot implement within your buildings. So moving forward, what can the private sector do? Well, I think articulating those benefits is really, really important. I'm not going to dwell on this slide, but ultimately what I would suggest is if you can reduce your indirect costs, say by 5%, the equivalent is increasing sales by 20%, and I think it's a no-brainer if you're going to understand what has the least cost associated with it in terms of resource. Certainly, if your profit is linked to bonus schemes and to employee incentives, rather than trying to get them to focus on sales, maybe this would be a much more efficient way to go, and that needs to be articulated. Also, I think if you don't have an appropriate, or I suppose if you're not risk aware, I think we talk an awful lot about being risk averse, but if you're not risk aware, then this opportunity may well pass you by. Certainly, I look at an energy performance certificate as actually not a particularly risky venture at all. Certainly, Paul's already mentioned the energy savings guarantees that you would get, and I've already spoken about the fact that we are in a volatile energy market. In fact, doing nothing is possibly more risky than investing at this stage. As I said, when interest rates are low and the energy market has currently plateaued but is set to rise, it's an excellent time to invest, and I would certainly recommend looking at that at the moment. But like I said, having a one-stop shop for a program, it reduces the resource required, delivers those economies of scale as well. So the opportunity to work closely with a single contractor, get what you want. And Paul obviously mentioned earlier, I'll just quickly say, he mentioned earlier that we don't have necessarily energy performance contracts that look outside of the cost savings and the carbon savings, but we work closely with Imtech when we installed our energy conservation measures to ensure that lighting colours and levels were appropriate for the places that we're putting in, including care homes, for example. We work to ensure that we work closely with our facilities management guys to dovetail any works that they might be doing in with our works to, again, drive further economies of scale. So there are certainly ways of increasing the value just outside of the carbon and energy cost reduction sort of remit that you would be given with this. Finally, what would I just say in terms of benefits? Well, I would say to make sure that this happens, agree a minimum return on investment, IRRs, your MPVs, with finance and your other stakeholders before tendering. I think this being able to do this will enable you to maybe alleviate the opportunities for energy performance contractors to do the sort of the cherry picking, the low hanging fruits, because you'll know what sort of longer term energy conservation measures you can install which have longer ROIs, because you can average out the total ROI of your contract. Gives you a bit more flexibility if you know what you're working towards up front. And agreeing the measurement and verification protocol for each measure is really key. I mean, if you've got a piece of equipment that's been installed to save energy and it's failing, but you've agreed an MPV on a whole building level, and that building's performing, ultimately your energy performance is still what it's expected to be, and you're not necessarily getting the most out of the energy performance contract. So know what you want to measure and how to measure it. And the last thing, a couple of things I would say, is make sure that you communicate what you're doing, because you will build traction with key partners as and when the benefits are realised. And finally, I suppose if you're not responsible necessarily for all those finances, make sure you agree the recharges, but also the savings in a strategy that is conducive to benefiting your tenants as well. And I think that's it from me. A few minutes for questions, I guess.
Fantastic. Thank you, Ben, and thanks, Paul, as well. So we've had lots of questions coming in, and if you do still have questions, please do keep sending them through. So to begin with, Paul, maybe you could pick up on this one, but someone's asking, how does NESCO avoid doing just quick wins, i.e. the more complicated the measures, the higher the performance risk? And that also ties in with another question we've got, which is around how do you assess if the savings being forecast are realistic? Do you want to share your thoughts on those?
Yeah, sure. Yeah, I mean, two very good questions. In terms of avoiding quick wins, and obviously quick wins are always the first part you start, because they're generally going to get the quickest paybacks. But they also actually increase your risk. If you only did quick wins, I mean, two things. A, we wouldn't probably win the work. And B, you've only got a limited number of measures that you're being measured on. So if one of those fails, you're not going to achieve the overall saving that you've signed up to. So from our side, we generally look for a very broad range. And the way the public sector contracts work, you wouldn't win it if you just did quick wins. It's very much, we have these buildings, we have this amount of capital, come up with the best energy saving, MPV or carbon saving, or whatever the metric is come up with the best saving across those pieces that you can come up with for that amount of money across those buildings. So you would look to come up with the best measures. And sometimes that does mean doing technically complicated measures. But as an engineering business, that's what we do. We are a business of a huge number of engineers, so we shouldn't be in this marketplace if we couldn't come up with good solutions that we can stand by. And the paybacks on those would fall out over that period. Now, in terms of then, how do we know that those savings are real or a true reflection of the measure? I mean, that's just in terms of the calculations we do and looking at the benchmarks and looking at what a retrofitted asset or a replacement asset would provide. And that's based on just simple measurement techniques and calculation techniques, along with experience of the team of people that we use to do it. Hopefully that answers those two questions.
Thanks, Paul. Ben, do you have any thoughts around assessing if savings are realistic? Do you have any sort of tips for listeners?
Yeah, I mean, as far as I'm concerned, the key thing, as I said, is to make sure that you understand the buildings that you're operating in. Making sure that you can anticipate changes in operation, I think, is really, really key. Certainly, what I've experienced, well, not necessarily through energy performance contracts, but I would certainly say that when you get suppliers pitching for work, you will inevitably find that they will give you the best case. Now, of course, the fact of the matter is that under an energy performance certificate, it would be, I suppose, not a particularly clever strategy for energy performance contractors to do that, because ultimately if they fail to deliver the savings that they say they're going to deliver, they're going to have to cough up the difference under the energy savings guarantee. So actually, I think by having the energy savings guarantee, you have to have a far more practical and realistic view of what the savings are going to be. But like I said, from a client perspective, we need to make sure that the information that we're giving to those bidders for that work is as accurate as possible. And certainly, like I said, in the public sector, we saw library opening hours extending, moving on to greater weekend opening hours, increased footfall through some of our buildings, which increased the energy intensity of those buildings, and of course the type of operations that we undertook within those buildings. And as a result, you need to make sure, but it's not just from the public sector, from the public and the private sector, you do need to ensure that you know what's happening in those buildings, and you can ensure that is taken into consideration when those savings are being suggested up front.
Great, thanks, Ben. Another question that's come in, and I think this is probably a question that gets asked quite a lot, is how can you get past the landlord-tenant divide in the private sector? Ben, do you want to give us some thoughts on that?
I can try. It's an interesting question, and obviously it's something that I've brought up as a reason as to why it's probably more, these contracts are more prevalent in the public sector than the private sector. I think up front, if you're going to invest in something which is ultimately going to be recovered through tenants, or indeed if you're going to install something within a tenanted unit, which in fact you may not benefit for in the long term, you need to have the open dialogue between tenant and landlord right from the off. You need to ensure that everybody is on board with what's being undertaken and what's being delivered. Certainly, my view under an energy performance certificate is that, as Paul has already mentioned, the savings that you make continue to eclipse the outgoing cost, then ultimately this is going to be a shared benefit for all. So my view would be make sure that you're communicating up front, make sure that the finances that are going to affect tenants are modelled effectively, and that you can demonstrate to them what the savings will be in the longer term. That's certainly from a real estate perspective. As a tenant, if I was going to install something, well, to be fair, it's hard to look at something beyond the term of your lease, really. That does create problems. I think in that respect, you'd have to look at what potential on-sale value or recovery you might be able to get from any sort of plug-and-play equipment you install, just to make sure that the full financial value of what you're doing is fully realised.
Thanks, Ben. Paul, have you got anything to add to that?
Yeah, I mean, there are, you can use green leases, which is, they've been used a reasonable amount in the UK to create that kind of contract between the landlord and the tenant on investment in energy efficiency assets. And that's a very good way of doing it and putting it in a contractual kind of agreement. But that all hinges on the fact that there is actually a relationship between the landlord and the tenant, and sometimes that can be quite a transactional relationship. So there isn't a physical relationship there. So that needs to happen, and I think it's, as Ben mentioned a lot, in his presentation there, communication. Communication is key. If you can get just the two parts there together, and so they can look and, okay, well, we've got a 5-year lease or 3 years left on our lease, but actually we are looking to stay here longer, then there's a different conversation. If someone's, look, at the end of this 3-year lease, we're off. We need to move into bigger premises or smaller premises, or we're relocating to another part of the country. Again, it's a different conversation. So that's looking at it in one angle, and the other angle is looking from the landlord's perspective, is looking at the energy saving and the long-term piece around that, but also the increasing yield from that property, potentially from making it a much more sustainable, low-carbon workplace, and having that metric in there as well to look at the ability to release that at a higher value later down the line.
Thanks, Paul. So it's like changing tact here, but Paul, who leads in putting together a consortium? Is it the asset financiers, the FM contractors? Who tends to do this?
That's an interesting question. It tends to be the people who have got access to the properties, because an investment model only works if you've got properties or assets to invest in. So if that investor is coming with clients or people that he knows of and who want to undertake an energy performance contract, he'd probably lead it. But it can work either way, and generally, the idea is that everybody benefits from it, so that can just sit in a joint venture or an SPV and look at it in that way, depending on the size and the scale of the investment, I guess.
Great, thanks, Paul. Ben, a question here you might like to tackle. Should you be looking to engage a third-party company to audit the benchmarking and ongoing measurement and verification?
Good question. You can do. I think that really depends on how good you are with your own data. Certainly, my view is that if you're getting appropriate data flows through from the metering and the sub-metering that you might have in your properties, and you have the appropriate skills in-house, I don't feel that necessarily a third-party audit of this sort of thing will provide anything. Certainly, in fact, as I've mentioned earlier, if you're more likely to know your buildings, what's happening in those buildings, and as a result, you'll be able to sort of make allowances for any changes in occupancy or operation. That being said, I appreciate that there is a level of security or comfort in having a third-party audit process. But what I would say is if you're agreeing a measurement and verification approach with your provider, is to ensure that you've got a third-party auditor that you're both comfortable can deliver the appropriate measurements and scrutiny on the installations that you put in.
Thanks, Ben. Paul, a question here which is kind of quite pertinent with 2018 fast approaching, but what impact do you think minimum energy efficiency standards will have on energy performance contracts in the private sector?
Yeah, I think it should generate a lot of interest in terms of people looking at, I need to meet this legislation, I don't know what to do, and an energy performance contract would work very nicely underneath that to get them to meet the requirement of April 2018, but also to future-proof it beyond that. So that they're looking long term. We want to hold this building or buildings within our portfolio. We need to increase the efficiency, to meet the legislation of 2018, but equally we want to meet it beyond. An energy performance contract can work very comfortably in both of those ways. And my personal belief is I think that will generate quite a lot of growth.
Thanks, Paul. Ben, I think this one might be quite good for you, but what should you be paying attention to when negotiating your energy performance contract? You've kind of got some experience in this. What do you think people should really keep an eye on?
Blimey, there's a lot of things because it's quite a complex contract. I think there's obviously going to be terms and conditions that you're going to need to be aware of. So as I said, making sure that your measurement and verification is spot on will ensure that the energy savings guarantee can be ratified, and of course any under recovery from the savings you get can be met through that mechanism. Certainly, you need to have a really good understanding of what your approach or appetite is for risk. So you're going to want to agree things around retention, damages. Certainly when we worked with Imtech, they were very, very flexible about enabling us to put in damages clauses should, for example, some of our buildings that we open to the public not open in time and be able to provide them with the services that they required. And I think it goes the same for the private sector as well. If you're not able to open a flagship store because your lighting's not coming on, you're going to need to ensure that you've got appropriate contractual remedy to make sure that you're not out of pocket. So I think these are the sorts of things I'd look at, certainly in terms of the approach to making sure that you're comfortable with your return on investment, working with finance, making sure that you do agree that return on investment, and making sure that dovetails with your asset management strategy. There's no point in going out and just saying, oh, come on, guys, we'll just take the best possible return on investment we can get. If that best possible return on investment is 12 years and you're planning on selling your key assets within 8. So making sure that you are aware of what your timeframes are, and also what is going to be appropriate for your stakeholders and your shareholders in terms of the sort of the minimum internal rate of return or net present value that you're going to get from the installations.
Great. Thanks, Ben. We've got time for a couple more questions, and one here. If both landlord and tenant are involved, what is the normal practice regarding repayments? I.e., does the landlord pay at all? Paul, have you got some thoughts around that?
My experience of doing it in the private sector, it varies massively. And yes, sometimes the tenants can take this on completely on their own. And we've done quite a lot of that, but they've got a relatively long-term view, or sometimes they're quite specific. It has to meet a certain payback period, so it does limit the types of measures you can do, but it can still be done because they quite like the concept of the guarantee of the energy savings and one company taking care of all of it, including the finance. And other times we've had both engaged and they both invest, so it's kind of a 50-50, and we've equally had it where the landlord pays but the tenant then pays an increase in his payments back to cover some of that. So it kind of works in a number of ways really, and I kind of look at it, I think more so in the private sector, you've got to be really, really flexible in terms you look at it, because everybody will have different drivers in terms of how they want this to work. And as long as you're flexible in that, an energy performance contract can sit quite comfortably amongst all of those.
Thanks, Paul. Someone else is asking, have you seen any good examples of energy performance contracts working well in the private sector? They've said they've spent a good sort of 4 months researching this and have only really come across a handful of examples. Ben, have you come across any good examples?
No. It's a simple answer. I mean, like I said, they're certainly prevalent in the public sector, and there's especially I've seen a lot of work in London being undertaken, but not just within local authorities, but also NHS trusts are doing an awful lot of work in this sort of area. But from the private sector perspective, as I said, there are a lot of issues, and you've obviously mentioned that some of it just then, a couple of the complexities around making sure that tenants are bought in and are appropriately recharged or or not, depending on the way that the metering strategy and who consumes what is set up in the building. So it is a challenge. We are just looking to embark on one ourselves here, but by no means is it an easy ride. There's lots of these considerations to undertake or to consider, and as a result, as I said, I can see why that might well restrict the number of successes that you might see in the private sector.
Yeah. Paul, have you come across any?
Simple answer is no. I mean, we have done some. I wouldn't say they are, they're generally reasonably limited, and sometimes they're not really energy performance contracts. It's a contract to put energy efficiency equipment into a building. And that can be financed, and it's done more on a lease model because the landlords or the tenant in that case were more comfortable with that type of language and that kind of contractual setup. So that's what we did.
Great. I think a good question to finish on then is, do you really think energy performance contracts will take off in the private sector? Although it's a powerful concept, do you think it's a good fit for private companies? Paul, do you want to give your thoughts?
Yeah, I mean, it's funny. It is an extremely powerful concept. I mean, I've been working in the kind of alternative energy sector for quite a long time now in different guises, and I've always looked at, an ESCO model or an energy performance contract model and just thought it is an absolute no-brainer. Why isn't everybody doing this? But as soon as you go into the private sector, there are a lot more complexities. But I do believe as the legislation starts ramping up, as we talked about minimum energy efficiency standards coming in April 2018, along with the cost of energy continually going up, I think there's a kind of a point where all of that clashes and people will need to do stuff, and an energy performance contract works very well. So I think there will need to be quite a lot of work around a standard model, and I know there's a lot of work happening on that at the moment with things called like the Investors in Confidence project, and I think that sort of stuff will help, and I think that will ramp up, so that increases the opportunity for the private sector. But I think we're a good few years away from it really stepping up as the public sector has done.
Yeah. Ben, what about you?
I think there are certain elements of the private sector where it could work extremely well currently, but it has to be typically in those areas where large organisations own their assets, and potentially they've been assets that they've had for some time, and probably no greater opportunity in the private sector would be that than the manufacturing sector, where they own lots of buildings. They're extremely energy intensive, and a lot of these buildings have been around since sort of the 70s. They're still working with halogen lights and things like that. So I think, yeah, absolutely, that would be a really good opportunity. And also some of your larger sort of superstores as well typically own their own buildings. So your out of town supermarkets like your Tesco's and your Sainsbury's, Morrison's, I think all of them as well have really good opportunities to ensure that they're looking at it. But ultimately, from my perspective, what you've got to look at, I suppose, as a tenant in properties is what your leases are like. If you've got sort of, 20, 25-year leases in properties in good prominent locations where you don't feel like there's any need necessarily to move, then take a look at them, review your leases, maybe pick those units wherein you're likely to stay for a long time, and focus your attentions there. So yeah, there are definitely opportunities. It's just about finding out where they are.
Great. Thanks, Ben. So we'll draw the session to a close now, but I'd like to thank Paul and Ben for their time today and for getting through so many questions, and also for everyone who joined us for this webinar. A recording of the webinar and the presentation slides will be archived on the 2 Degrees platform, and as soon as those go live, we'll send out an email to you all just to let you know. So I hope you found today interesting and useful, and that you'll be able to join us for more webinars in the coming months. So thank you, everyone.